What's going on, everybody? Michael Silva here. Are you prepared for the next economic downturn? Today's video, we will be deep diving into the charts that are flashing warning signs of an impending recession. We're going to explore some key indicators that suggest financial storm is brewing and discuss the potential impact on the stock market. Let's get into it. Welcome back, everybody. We're looking at the Fed Watch tool here. This allows us to see the probabilities of where the Fed may move the target rate. The current target rate is at 475,500, but now there's an 83% probability that when we go into the May meeting, they're going to keep rates at 475,500. That means that the Fed hiking cycle is coming to a potential pause. And you can see after just a couple months of pausing, the market is trying to price in that they will start reducing the rates. Now, we already know that Jerome Powell said that that is not what their plan is to do. They want to keep rates higher to bring down inflation, but the market is starting to look forward that they will be reducing rates. Now, if that is actually the case, let's look at what happens typically to the market when we start getting the Fed to start tapering off or moving rates back down. Well, there's been a couple of instances here where we can look back to 2000 and 2008 where we had these yield curve inversions. And what happens is when they start coming out of inversion, some things happen. You can see just by looking up at the top of the S&P 500. But if you pair that to when they start reducing rates, so this is the federal funds rate down here, boom, they start reducing rates. Boom, if they pause and they start reducing rates, what that might look like. Well, let's take a look. When they start reducing rates, if you just go up, wow, the market sees a lot more turbulence. Same with right here when they started reducing. That was the financial crisis. So what might happen if they start pausing here and then they start reducing rates back down? Does that mean the market may potentially start heading lower? Well, just to give you an idea of where the market may go, we can just look at prior times that we went through these cycles, and you could see a 51% drop, a 58% drop. So I drew out, hey, what would a 50% drop from the peak to here look like? Well, that can bring us down to 2,500. Now, that's not what I'm predicting, but I'm just looking back through history to see, hey, what has happened in the past. Now, what I'm starting to see now is we're starting to see a flight to safety. And this is very important to note because of the economic cycle that we're currently entering into. So you can see down here, this is the relative performance between bonds and stocks. Now, typically before a recession happens, bonds start to outperform the stock market. Typically. And what you see here is you start to get back above this 50 EMA and we're starting to base out right here. And then another thing to add on to is gold is outperforming the S&P 500 here in recent trading days as well. Both that kind of point to a flight to safety. If I take a look at the chart of gold, it looks like it's, this is a monthly chart of gold. And, if 12-year cup and handles are a thing, this is one big cup with a handle, which would explode us to 3,000 gold to 4,000 gold if that was actually the case. If I take a look at the price percent oscillator down here, we had a bullish crossover. As long as gold can hold up there, that's going to be a bullish crossover. Okay, we've already up 8% on the month, so it may need a little bit of time to settle here. But the last time we saw that was in early 2019. And that's when we got that big ramp up in gold there. The time before that was right here in 2016, we got a big ramp up. And then the time before that, well, you'd have to go back over here to just out of late 2009 where we saw gold really start to ramp up there too as well. Okay, so as it stands right now, we're starting to see a bullish crossover. It's above the zero. Hey, is it going to start breaking this area? And we're going to start to see bigger flight to safety in gold. It's a possibility, especially for a long-term holder. I can see why you might want to start accumulating. But if you go down and drill into the smaller time charts, it may need a little bit of digestion here. Another important aspect of this is obviously the TNX, the 10-year yield. We had the price percent oscillator. It's starting to curl itself over. We've been on such a rapid move to the upside, and now what we're starting to see is the RSI back off. We're starting to see this curl over. The last time we saw this actually have a bearish crossover was when? It was right there going into 2019 where we saw yields really take a big nosedive. The time prior to that, as far as the bearish crossover goes, was right here in 2016. So this is a long-term chart. These are monthly charts, but it's still good to get an idea when these crossovers take place because it could potentially change market turning points in the trend. And another important aspect of this is when the 10-year yield starts backing off, well, you can start to look to bonds as a flight to safety, right? Yields go down, bonds go up. And you could see as it stands right now, the bonds are starting to find itself a potential bottom. We're starting to base out here. Okay, this is on the daily time frame of TLT we're using as a proxy, and it's starting to trade above these moving averages. So the moving averages here, you can notice they're all flowing down. Okay, it's a big bearish trend. So every time we had a move down, it bounced up, but it followed the river to the downside. Bounced up, river to the downside. And now what you're starting to see is you're starting to see the river neutralize, which means that, hey, now we're going into a neutral trend. This could be accumulation. And if we start moving up, it's going to start turning these trends up. You're going to start to see these smaller moving averages, the 20, 50, 100, all get above the 200, and then potentially start doing the opposite and start moving upwards. That would be the bullish case there for bonds. So remember this, okay? So we have bonds that are potentially going to go up. We have gold that's kind of being a flight to safety. We have yield curves that have been inverted, which are also a sign of a potential recession to come ahead. It's been at least one of the best indicators for recessions to come. And then we have stuff like oil that's been taking a huge nosedive. Looking at this monthly chart, remember, large spikes in oil typically, you know, bad things happen after that fact. And if we take a look at a rate of change of 12 months, so a yearly rate of change, whenever we got up to a huge move, say this 100 marker right here, you can see we had the 1987 crash, the 1990 crash, the dot-com crash, the financial crisis, and now we had this monster move in oil because it was coming out from some very severe lows. And you can see now we're starting to cross down through a negative rate of change. So oil, which is what? Commodities, right? Commodities are getting hit, which is an important aspect of all of this. Okay, also to note, breadth is not too good right now in the markets, meaning the markets are holding up. They're stabilizing right now, saying the NASDAQ composite, for instance. But what you'll notice here is if I take a look at the percent of stocks above the 200-day moving average, I want to take you back to a time. I did a video on this in November. I showed this chart in November, I believe, of 2021. Yes, November 2021. So over right here, I'm going to draw a line where I started making this video. Oh, what do you know? That's right here around the market top. Okay. And what we called out was, hey, take a look at how breadth has been going down, meaning that the percent of stocks that are above the 200-day moving average were getting less and less and less. And at that time, what was happening? The market was going higher and higher. So what was going on? Well, there was few stocks, the big mega cap stocks, that kept on pressing higher and higher, and it was masking all the weakness that was going on behind the curtain in the market. And that gave us some great insight to saying, hey, like either we're going to have a monster melt up here because if all those stocks start performing with them, or we're going to start to crash. We're going to start falling down. And that's what we did in 2022. And you can see we've seen times where there was divergences here. All of a sudden you had a high and a lower high, meaning price was moving up higher, but yet internals were weakening, internals were weakening, internals were weakening, all in those time frames right here, and it led to market sell-offs. So you can see as the NASDAQ composite's holding up well here, we had around over 50% of stocks in the NASDAQ composite were above their 200-day moving average, but in just a short period of time, we are now dropping to 28%, meaning that the breadth is leaving. The market is currently masking by its stabilizing the main indexes, but a lot of the products, they're falling. Okay, so remember that. And then you could take a look at something like the summation index. It crossed down through zero. The parabolic star is still here, so that's bearish. And then NASDAQ McClellan Oscillator 2, we're starting to build some stair steps up, but it's still negative breadth. It's usually a good sign when we get back above zero, as the market has just been kind of holding up here. You can take a look at something like the NASDAQ Advanced Decline Line. What I did is I applied a couple EMAs here, breadth EMAs, okay, the 21 and 50, and you usually want to typically see that above zero. This is something that I learned from David Knepner. I always forget his last name, Knepner. If you watch this, sorry, you're going to have to tell me how to pronounce your last name. But something that I want to call out here on this chart that I like to do is look for divergences. And you can see here, you have highs and then lows, where you have highs and then higher highs. So you have price action in the Qs, the NASDAQ, right, 100, moving up higher because, well, it's led by a few mega cap stocks. But on the NASDAQ composite, you still have really bad breadth going down, okay? So that is just more proof that there's weakness in the markets despite seeing some bullish activity. You can see the NASDAQ composite bullish percent index. It's still in oversold conditions, meaning that there's a lot of stocks that have not been, moving up higher as the NASDAQ composite's been holding itself together. What does this mean? Well, we're talking about Are we prepared really for the next economic downturn? And if I take a look at the business cycle, once again, I'll show you, it's just pointing more and more that, hey, we're around the corner from the recession, if not already entering into it. But stocks, they're falling despite seeing some of the strength. Commodities, they're falling. You can just look at oil. And bonds are starting to stabilize. So we are here in the early stages of the contractionary phase. But now this is where it gets interesting to me, is because I think that we are now, as far as finding a stock market bottom, as far as price goes, I don't know where that bottom is at, but as far as time goes, I think within time we are very close to finding the market bottom based off of time. And if I look at something like the S&P 500, you can just see clearly by looking at this monthly candle, the market is confused. Why? Well, there's a lot of indecision. This right here, the month isn't over yet, but this is known as a doji candle, where you have a long range body and then you have price just, it opened here and it's currently standing right there. So it moved all the way down, it moved all the way up, it moved all the way back. And this right here is just telling us there's a lot of indecision taking place. I mean, we've had a huge range in the S&P 500, probably around 7% or so, and you can see we're up 0.02%. Okay, and if I take a look at the S&P 500 on the daily time frame, we've been trading within this range between 3,900 and 4,200 for quite some time, right? We get outside of it, we came up, we bounced to 3,900. We said, well, start to look for 4,200 as a target. Boom, came to 4,200. Guess what? We got outside of 3,900. We came back in, we back tested 3,900. Are we setting up for another time? We're just going to go right back to 4,200 and it's just going to sit here and wear us out by chopping back and forth? Hey, we got to think of that as a potential possibility. I will say this is a somewhat of a bullish pattern forming right here. You have a broadening wedge, descending broadening wedge from a move that's been up. So, hey, if this does break out, it can give us to that 4,200. Potentially, actually, a measured move could take us up to the August high, which is around 4,300. But if you take a look at the backside of this, it also looks like, hey, we could just be bear flagging. It might take some more time to move around. And we talked about that on the prior episode, where then you might start seeing people say, oh, look at, it's a inverse head and shoulders. And then that would take us where? It would take us right up to that 3,900 there too as well. If I take a look at something like the Qs, right? The Qs are doing a lot more movement on the month. You can see we're actually at the monthly expected move right here. We came outside, we're back in, we're above the quarterly expected move. Okay, so 68% of the time it finishes within these. So hey, is the Qs going to start backing off to 30 or 300? That's a possibility, but the quarter's almost over here, so there'd be a pretty big hit. Okay, we have the price percent oscillator starting to curl itself over here too. So it looks to be bullish as it stands right now in the Qs. All right, but if we take a look at the daily time frame, they have already made a very monstrous move in a short period of time, right? 285 to a high of 315 there is a pretty significant move. And you got to understand, it's going to have to digest this at some point, okay? So it's going to have to take a little bit of a breather. When that is, it could be very soon here, right? It can come back up to 315, it could come right back down to 310, it could come back to 300, and it can go waffle sideways for quite some time. Now, if we take a look at the internals of the NASDAQ 100, what are the stocks that make it up? Like, what are the biggest weightings? Well, two of them right here make up for 24% of the NASDAQ 100. So Microsoft, Apple, okay, and we'll talk about NVIDIA. You know, we have Tesla and Meta too as well. And if you take a look at some of these, they also went on monstrous moves in a very short period of time. These things, it's not going to hold this type of rate of change. It's going to have to consolidate. It's going to have to digest the gains and pull back at some point. Okay, and Apple, same thing. It's been on a nice move, breaking out of this. It looks, I think on prior videos, we said 170 was a potential target on that. NVIDIA has been making a just nonstop ramp to the upside. Now it's running into some overhead supply. If I don't have that chart with me, but it is. You can see it's kind of just waffling sideways here for the last couple of days. Meta was another one that's just been constantly grinding higher right over here. And then also, if we take a look at Tesla, it's been on a pretty rampant move, but this one did take a little bit of a breather, and it's kind of going sideways as it stands. So if we really put this all together, if the Qs are going to start backing off a little bit, and we take a look at all the internals that have been kind of just taking down, it could give us insight that, hey, we might be in for just a more chop in the overall markets. You can see here on the bullish percent index for the NASDAQ 100 does not look like the bullish percent for the NASDAQ composite. We had this positive divergence here, and then we started to see the move higher, and you can see this is not an oversold or overbought condition. Now, let's take a look at the IWM on the monthly time frame. This one is down 8.37%. But why? Well, because of the financial crisis that has just taken place, right? We have small banks, regional banks, big banks. They all took a big hit. And then we also have a lot of energy companies, heavy commodity intensive companies taking a big hit too. So this right here has been backing off. It's still within the quarterly expected move, basically unchanged on the quarter for the most part. You can see it's pretty much just centered in between these dashed lines, and it's outside of the monthly lower expected move. So this does not look too hot overall. But if I take a look at something like the BKX, this is the banking index. I think it makes up of, if I remember correctly, the largest 24 institutions. And I just wanted to call out that, hey, we've saw a huge hit, right? 28% in 1 month to the downside. And I want to call out that, hey, we are moving into a potential trend line of support. And we started bouncing from this area. So if the banks start stabilizing, or we get some sort of, little bit of a bounce or something like that, that could potentially stabilize the downfall of the IWM in the short time. And if I take a look at the IWM, where have we been since, May of last year? We've gone nowhere. We're sideways, right? We've been chopping back and forth. Are we looking to break this level of support down here and head further down? Or are we going to start bouncing back up? I will say this break with this volume, right? That's a pretty large break. The last time we had a pretty large break was down here, and that was on increased volume. And that's what created all of this sideways chop over here. So it's still holding this area. I'd say, 160 would be a key level, 160 up to 165. So if we start pulling more into this area, we can find bounces. But also to note, we undercut this main area and we started to find somewhat of a bounce. So if the banks start to bounce, if financials or if energy starts to get a little bit of just a leeway and stop getting crushed, we could potentially see a little bit of a relief rally, but we're under the key moving averages. It's a time to be very careful trading this kind of stuff. So it'd be for more aggressive type traders. If you take a look at something like the NYSE bullish percent index, right? This one's still in very overextended sold territory here, but you can see that we can get down pretty extended down to around this 25 to 20 marker, means the percent of stocks that are on buy signals based off of point and figure charts. And that can open the door for potential really big bounces there in the New York Stock Exchange as well. Okay, so let's continue on. We're going to go into some 15-minute charts. We'll talk about Friday's price action. It was really kind of a low volume, floaty type of day. If I take something like this S&P 500 on the daily, you can see the day was up, right? We're up, 0.5%, but we started by gapping down. It was on low volume, and we kind of just traveled up slowly but surely. So this could be could be just bear flagging some more right here. I would say keep an eye on these weekly expected moves. 404 to the upside, 386 to the downside. As far as tomorrow goes, 391.47 is the daily expected move to 400 to the upper expected move. We have got price just slightly there back above the 5-day moving average. The 5-day moving average is inclining, and we're still below that year-to-date anchored VWAP, okay? So as it stands right now, where are we going? I mean, we're really just kind of going sideways. I think we still need more digestion. If we start breaking above this level, right up in this range up in here, let me see if I can draw a little box up in this area. That opens the door, from my opinion, to 404. But it's not something like, if we gap up tomorrow and we run up there, it's not something that I would necessarily want to chase. I would want to see price pull back, consolidate. So it just does not look like a healthy market as it stands right now. If you take a look at the Qs, right, we've been on this monster run since the bottom over here. You can see that the 5-day moving average is currently holding. As far as levels to watch going into next week, look at the weekly expected moves. 319.63 to the upside, 302.15 to the downside. Like I said, if I saw a very clear, setup here, I'd let you know. But as it stands, we just see the slow grind. Nothing here looks like a good setup. So I'm going to have to see price action tomorrow to see if anything else sets up. This one is interesting. So the IWM, as we stated, a lot of things are going into this oversold conditions. And you can see here we undercut this prior low. So as on the 15-minute time frame, we're kind of chopping sideways. We undercut, and that basically looks to flush out some long positions, right? It hits stops, maybe initiates new short positions and so forth. They're like, okay, I'm going to short here. And then all of a sudden we get this reflexive type bounce, which then creates somewhat of a bounce, right? Because you have to be like, okay, well, now if you shorted here, you would look to cover. And then if you have new momentum long buyers trying to buy the right side of this U-turn and so forth, that could create a potential move higher where we could look for 177.50 and even potentially that month to date. You can see the 5-day moving average has been declining and we're starting to go neutral here. So this could be potential pause of accumulation. And if we start getting back above this 5-day moving average, it could open the door for potentially this 177.50 to higher. So that's kind of where my eyes are at going into this next week trading session. Be careful, be safe. I hope he gave you some insight to really kind of understand that the economy does look like we're moving into contractionary phase. It does look like the recession's around the corner. We're talking about the Fed, right? They're talking about tightening lending standards and so forth. This is not pleasant stuff. So what happens if we amplify it, or what typically amplifies this, is the late stages where you'll see jobs, the unemployment start to rise, and that's when things could get a little bit difficult. So we'll talk about that on other videos on how to prepare for a recession and getting your own economic household in order. That's all I got for you on tonight's video. Hope you liked it. Make sure to like and subscribe if you haven't done so already. It's greatly appreciated. See you later.